Hi folks, and welcome to the Meaningful Money podcast. This is session number 356. This is the podcast dedicated to helping you put your finances in order. My name is Pete Matthew, and I'm going to share with you everything you need to know and everything you need to do to secure your financial future. I'm here to help you make sense of money. Hey, great to have you with me. Thanks for joining me once again. Today, I get to bring you what is easily my favorite interview in the nearly 10 years of this whole Meaningful Money project. Back in November, it was my privilege to chat with J.L. Collins. That's Jim Collins, author of the amazing book, The Simple Path to Wealth. So I'm looking forward to bringing that interview. After that, I'm going to look at a review that's been left and talk about some other stuff as well, briefly. But before any of that, remember this podcast continues to be brought to you with the help of my friends at 7 Investment Management. They've been helping me out here for years now. Shows amazing grit on their part to keep going and support me for so long. So I'm really grateful to them. Please do check out what they're up to. They're at 7im.co.uk. That's the number 7im.co.uk. And don't forget the new Meaningful Money branded self-investment platform even, which they've built. If you're looking to get started investing or maybe diversify what you're doing already, everything you need to know is at meaningfulmoney.tv/podcastinvest. Okay, go check it out. Okay, so The Simple Path to Wealth is, for me, the greatest personal finance book ever written. Yep, it's even better than the Meaningful Money Handbook, and it's deservedly sold about a gazillion more copies than my book. I don't want to keep you waiting any longer than necessary. Plenty of people in the Facebook group have been badgering me for this interview, so let's get right into it. But stay tuned to the end, because I'm going to be giving away 10 copies of The Simple Path to Wealth. Find out how after the interview. Remember, notes, links, full transcript at the show notes. It's the only link you need to remember, and I've made it really easy this week. meaningfulmoney.tv/simplepath. All one word. meaningfulmoney.tv/simplepath. Here's my interview with Jim Collins. Well, this is a real delight. It's my privilege to welcome Jim Collins, author of The Simple Path to Wealth, to the Meaningful Money podcast. Jim, how are you doing, sir? Thank you for joining me.
Pete, I'm doing well, and it's my delight to be here, and I'm honored that you asked.
No, it's very cool. I promised myself I'm not going to fanboy too much, okay? So let's get into it so that I don't. Can we just start, Jim, with a bit of backstory, please? Who you are, what it is that you do, and how you got to the point in life where you are now, please.
My name's J.L. Collins. I write a blog called J.L. Collins NH, and out of writing that blog came a book I published a couple of years ago, The Simple Path to Wealth, and all of that started in 2011, and it started because I kind of turned my daughter off when she was young to this whole investing thing because I pushed it too soon and too hard.
Okay.
And but it's very important, and I wanted to make sure that she had access to this information when she was ready to receive it, and I couldn't be certain that I would be around at the time, so I started writing it down. And one of my friends, I shared it with one of my friends, and he said, this is kind of interesting stuff, and I'll bet your other friends and family might be interested in it, and you should put this up on a blog. And at the time, I'd heard of blogs, so I kind of vaguely knew what they were, but I'd never actually seen one. And I joked that the first blog post I ever read was the first one I wrote, which is actually factually correct. But I like the idea as a way to archive the information for my daughter. And that was really my sole purpose in creating the blog. Now, I did take my friend's advice, and once I created it, I sent a link to it to my family and friends, and of course, they didn't care at all. But a very interesting thing happened that over the course of months and then stretching into years, it began to develop an audience, and that audience kept growing. And now I'm talking to you, and it's international. The audience is international in nature, and nobody's more surprised or stunned by that than I am.
Where did the interest in investing come from then?
You know, I I think that I've always been a saver, and I can't tell you where that instinct came from because it's really embedded in my earliest memories. I assume it's something that my parents somehow instilled in me, or for all I know, maybe it's genetic. And then the interest in investing when I graduated from college and got out in the working world and was finally making some money was an outgrowth, I think, of that savings instinct. And I knew that I wanted to have what I've come to call FU money, and that's a term that I found in a novel by James Clavell, because it represented freedom. It represented the ability to step away from jobs whenever and for whatever reason that I cared to. And in fact, that's what my career over the years looked like. I liked working. I liked my career. I just didn't like doing it all the time. And having investments, having this security, allowed me the opportunity to step away at times of my choosing and for lengths of time of my choosing.
Perfect. And you've sort of encoded everything that you've learned along the way in the book, The Simple Path to Wealth. Now, my friend Andy Hart, fellow financial advisor, financial planner, and fellow podcaster, calls The Simple Path to Wealth the greatest personal finance book ever written. And it was he that put me onto it. Having sort of read the book twice and listened to it twice, I have to agree. Now, I wonder what the trigger was for specifically putting it in a book, taking it from a blog post. Was it just wider reach, or I'm fairly sure it wasn't the royalties?
Well, first of all, I thank your friend Andy for me, and by extension, I thank you. That's truly high praise indeed, and I am very gratified and pleased at how well the book's done and the stature that it seems to have developed. But I'm also a little bit surprised by it. Writing a book is a lonely endeavor, and it's a lot of work. And while you're doing it, or at least while I was doing it, I had no idea whether anybody would care. I kind of knew that it would have some success because of the success of the blog, and I knew I had those fans out there. And
sure.
But that's, frankly, a fairly limited audience. And so I've been a little stunned at how well it's done. Writing a book was something that I'd always wanted to do. For some reason, I can't tell you, Pete, exactly why. It was always a vague goal in the back of my head. But I never had a subject matter. And frankly, I don't think I ever had the discipline. But after a couple of years of writing the blog, I suddenly realized that essentially I'd created the material for the book. And I thought it would be a pretty easy process to massage it into a book. Well, it turned out to be a kind of a nightmarish process. And it's akin to if any of your readers have ever bought a really rundown house with the idea of renovating it. And people I've talked to have done that, have almost to a person said, I'd have been better off bulldozing the thing and building it from scratch. And the only reason, by the way, that the book exists is because of my editor, Tim, who kept dragging me back to the project. I spent 3 years working on it, and that really represents maybe a year of actual work and 2 years of throwing it down in disgust and dismay and going off and saying this is just way too much work and too much pain, and I don't want to do it anymore. And then Tim would laboriously drag me back and say, no, this is important. This is something people will read. This is something they do need to know. And he believed it much more deeply than I did. And it turns out he was right. It seems to have resonated with a lot of people.
Lots of comparisons there with my own journey as a writer. It was exactly the same. I didn't think I had the discipline. And then my editor said, you do realize that, you've been writing podcasts for the last, sort of, at that point, 6 years. I probably had 750,000 words written because I script my shows, the lecture shows that I do anyway. And so I was like, yeah, absolutely. But do you know what? Every single word of my book was written from scratch. It certainly wasn't cut and pasted.
Well, yeah, you were smart enough to bulldoze the structure and build new. Gloria Steinem, I'm not sure how worldwide she's known, but she's an American feminist and one of the leaders of that movement, a very prolific author. But in any event, she was asked at one point if she liked writing. And her response was, "I like having written." and I think that, yeah, that's perfect. That describes me exactly.
Yeah, I'd agree with that. I think a large part of the appeal of The Simple Path to Wealth is its simplicity. The clue is in the title, right? But I wonder, have you ever had anybody tell you that it's almost too simple? That there's got to be more to it than you espouse in the book.
Oh, sure. I wrote a post, I want to say maybe a year ago, that's titled Too Hot, Too Cold, Not Pure Enough, and which addresses that issue. So I routinely have people tell me, you recommend very heavy allocations in equities and stocks, and that's just way too aggressive, and that's the too hot part. And then I have other people who are writing me and saying, you're way too conservative. If you tweak it this way or that way, you could get this better result. If you leveraged your investments, think how much more you would have had. And so you can always do things that are more aggressive or more conservative. For me, and the reason I wrote this book, and this is simple because it's me telling my daughter what I want her to do, what I think is best for her. This is the best path. It's powerful in terms of results, but it's not crazy with risk. As long as you stay the course, because the market's very volatile, the market will take periodic plunges. And if you panic and sell when that happens, then my advice will have left you bleeding by the side of the road. Don't follow it. That's a critical thing for anybody listening to this to understand. But if you stay the course, if you ignore those drops, and if you understand the market always comes back, and should the day come when that's not true, then where we're invested will be the least of our worries. The market always comes back from these drops, and as long as you don't panic and sell, you'll be fine. In fact, if you keep investing during those times, you can make those drops your friend. You can profit from them.
Absolutely right. Behavior is a key part of this, something I'm always talking about here.
Amen.
Could you sort of outline, in summary, your sort of core investing message, Jim, please?
Well, I think that I was asked that question at one of our Chautauquas where I was giving a talk, and I said, basically it's buy VTSAX, buy as much as you can, whenever you can, and hold it forever.
Love it.
VTSAX, by the way, is Vanguard's total stock market index fund, and it's focused on the U.S. market. So it might not necessarily be the right recommendation for international listeners, but it's the core of what I talk about on the blog and the book. So it's pretty simple.
Yeah, and it's all the better for that, I think. I wonder, and there are similar equivalents, obviously, here for the UK. I wonder sort of how that might transpose to a UK audience. Obviously, for a US investor, the US stock market being more than half of world stock markets by value, arguably it's more representative. Whereas if a UK investor was to buy just, say, the FTSE All-Share Index, I imagine it would be probably a little bit less effective. Would you agree with that?
I'd agree absolutely with that. And not just for the UK, but virtually for any other country other than the United States. The United States is unique in that, as you point out, it's just so dominant in the world economy and by extension in the stock market, that Americans like myself can get away with just buying one country, the United States. Now, if I lived anywhere else in the world, I would probably buy a world fund, a world index fund, and I forget which one Vanguard offers, what the name of it is, but they do offer a world fund. You need to be sure that it includes the U.S. because it's such a big part of it. But yeah, I'd buy a world fund. I'd want to own the entire world at that point. And in fact, and I've said this in some of my talks and on the blog, as time goes on, and I'm talking likely decades, so this is not a prediction I'm making for the immediate future, and the rest of the world, the economies of the rest of the world continue to grow and expand, which they have pretty much since World War II. That slice that the U.S. owns of the world market and the world economy is going to shrink. Now, that's not necessarily bad for the U.S. because it will be a smaller percentage, but of an increasingly expansive pie. So that can still be a very, very good thing for the U.S., but it will no longer have the dominant role that it has today. And in fact, we can see that that's been happening for the last 70 years since the end of World War II. And the end of World War II, all the industrialized countries of the world, other than the U.S., were in ashes. And not surprisingly, coming out of that war, the U.S. accounted for almost all of the economic world activity. But, of course, the rest of the world didn't remain in ashes. It rebuilt and grew from Asia to Europe, the UK, and that's a process that continues. And now, of course, what we used to call the third world, those countries are their economies, by and large, are getting better and better. So the U.S. percentage of the pie is destined to get smaller and smaller, but the pie itself is going to be larger and larger. So if I were anywhere other than the U.S., I would be investing in a global fund. And in fact, I tell my daughter that at some point, this is the one thing she does have to pay attention to. And at some point, she's probably going to want to step away from my beloved VTSAX and go into a global fund, whether that's a decade from now or 3 decades from now, or I don't know, but I think that's the trend I see.
Yeah, I'd agree with that. If you were in a global fund, then would I be right in assuming that you would want a fund which roughly matches the weights of the different stock markets that it's tracking?
Absolutely. And in fact, again, I wish I had looked it up for you, but Vanguard offers just such a fund, and the various geographic locations of the world are weighted according to the size of their economy. So the U.S. is about half the size of that fund. Now, to be clear, the U.S. had you done this 10 years ago, your performance as measured against VTSAX, which is just the U.S., would be much less because the U.S. has just had a much stronger run than any other country in the world for the last 10 plus years. But there's no guarantee that that's going to continue. And as I say, at some point, gradually that will begin to change.
Tell me about the love of Vanguard and where that comes from, because it's something obviously you talk a lot about in the book. I'd just be interested to know your thinking and the history behind that.
Yeah, so I have. That's one of the criticisms that I get, is that I'm a shill for Vanguard, and I've been accused for being on the take, and because I am a huge fan and I do talk about them all the time. So let me just go on the record of saying that I'm not on the take. Vanguard has never paid me a dime. They've never offered to pay me a dime. Insofar as I know, they are not aware that I exist. I have a pretty meaningful blog in the financial independence space, but against the size of Vanguard, it's a drop in the ocean. So Vanguard and I do not have a tight relationship. The reason I'm such a big fan of Vanguard is that unique among all investment companies, they are structured in a fashion that puts what's best for Vanguard on the same side of the ledger as what's best for their investors. And that's because it is investor owned. Vanguard is owned by the funds that it operates and therefore by the shareholders of those funds. So Vanguard's only serving one master, and that is you, the investor. And that's why their core mission is to drive down expenses. There's no point in Vanguard charging any more than the minimum they have to operate the fund, because that excess money would simply go back in a more taxed fashion to the people who own Vanguard, which is to say the people investing in those funds. This is very different from any other investment company. So Apple, for instance, not an investment company, but Apple makes their devices, their phones, their computers, and what have you, and they want to sell as many as possible. So they have an audience of customers that they are trying very hard to satisfy. But they also have shareholders, and they're trying very hard to satisfy those people as well. And that's a balance they have to strike, because they want to be as profitable as possible, which means selling their products at the highest possible price, consistent with selling as many as possible, and that their customer base will accept. That's the same thing with every other investment company. So if you go to Fidelity as an example, and I don't mean to pick on Fidelity, but Fidelity is a privately owned company, and they have as part of their core mission to maximize return to the people who own Fidelity. Now, the way they try to do that is the same way that Apple does. They try to create a product that customers will buy, but their incentive is to sell that product for the highest possible price. And in the investment world, that means the highest fees. T. Rowe Price is a publicly traded investment company, and they have shareholders just like Apple. They have, again, two masters they're trying to serve, and therein lies the difference. So as a core value, Vanguard is always driving down costs. Doesn't necessarily mean they're always the cheapest fund in any specific comparison, because, of course, other investment companies are always trying to figure out how to compete effectively with them. But they are the only one that have that as a core value.
Vanguard are popular here, very much so. They're relatively new entrant here in the UK. I think maybe the last 11 or 12 years they've been on the scene, which is, relatively recently. A core part of their offering here is called the Life Strategy range. And so this is a multi-asset fund, essentially. It's equities and bonds, globally diverse, but with a fixed asset allocation. So you can buy a 60% equity version, and it'll be 60-40 equities and bonds. And then there's higher or lower equity splits than that. And there are other companies, other multi-asset funds are available, folks. 7IMAP, Close, Tactical Select. It's become quite an increasingly popular sector of the market now. I wonder whether you had a view on those, Jim, as a kind of done for you, fire and forget solution for lazy people.
I do, actually, and I have a post in my stock series about them. They're also similar funds, and I have to be honest, Pete, it's taxing my memory. They're similar funds that change as you get older. And I'm drawing a blank on
sort
what
of
they call
dates.
those. But
they're called target date funds.
Yeah. Exactly. Thank you very much. Target date funds. And it's a similar concept in the sense that the target date fund is a basket of funds, basically, that provides different kinds of underlying funds that might be equity, might be bond, might be U.S., might be international. And the only difference between the two is the target date fund changes that mix as you get older. I think these are both great options. My only hesitation with them is they do carry higher expense ratios. Mm-hmm. So it's a little more expensive to operate them. But for somebody who really wants to be hands off and not have to think about this stuff at all, and have the rebalancing done automatically for them. Both the rebalancing as different sectors perform better than others and you need to adjust that, or rebalancing as the mix changes and you get older. I think it's a fine solution. My suggestion would be anybody who reads my stock series on my blog or reads the book, The Simple Path to Wealth, if you read that and you come away saying, yeah, that's simple, but I really still don't want to do that, then I think these are a great option for you. I like to think that most people who read my material will come to see that this is really not that complex, and it really is easy to do it on your own. And if you're willing to do that, you only need a couple of funds, and you only need to adjust them maybe once a year for the allocation. But I do get that there are a lot of things in my life that I just don't want to deal with at all. And I do understand that for some people that's investing, and these, for those folks, are a great solution.
I I remember exactly where I was. The first time I consumed your book, I listened to it. Okay. And I remember I was in a gym in a hotel when I heard you say the date you choose for your annual rebalancing. Do you mind sharing what that is?
It's my wife's birthday.
I remember nearly falling off the cross trainer. I thought, what a fantastic idea. I'm sure she doesn't mind.
No, and it has the effect of, other than it being my wife's birthday, which is meaningful to us, it's totally random as far as the stock market's concerned.
I love that. Yeah, we're not overthinking there. That's just an arbitrary date, but one you're never going to forget. I love it. Jim, we are 11 years arguably into, the longest bull run in market history, really. We've not had anything like a prolonged decline in stock market values since 2007, 8, 9. My fear is that for many investors, certainly who are coming to this whole investing journey latterly, they've ridden the markets higher and higher over the past decade or so. And when there's a real sell-off, they may be left, as you say, bleeding by the side of the road. How can folks prepare themselves for the inevitable correction in stock markets?
Pete, that's a great question, and it's one that I think about a lot, because that period of time, of course, coincides with the beginning of my blog. So for the entire time I've been writing about this stuff, the stock market has done nothing but go up, and at some point, and I'm not predicting it. I mean, just because it's been going up for a record amount of time doesn't mean it has to fall in the near future.
I agree.
It could continue to go up. I'm not predicting that. It could be crashing as you and I are talking today. I don't know what it's going to do next. And the truth is, nobody, especially not the people who claim they know, nobody does. Now, with that said, I can say with great confidence, eventually it's going to drop. Now, it could be a small correction of 10%, which are pretty common. It could be a bear market defined as 20%, or it could be a debacle like we had in 07, 08, and those, thankfully, are pretty rare things. I do worry that for a lot of younger people who have come into the market for the last 10 years, it's easy to say, oh, yeah, I understand that it drops and I will stay the course and it won't be a problem for me. But I'm not sure, if you haven't actually lived through it, that you know how you're going to react. And I often wonder if all the writing I do, telling people to expect these things, to telling people that these periodic drops are perfectly normal, they're a part of the process, they're meaningless as long as you don't panic and sell. I don't know if just hearing that and reading that is enough, because when the market's dropping, and especially when it's dropping in some significant fashion, it's extraordinarily scary. And let me delve into that just a little bit with a thought experiment. So typically people look back at 07, 08, and they say, well, the market dropped about 50%. Could I tolerate my investments being cut in half? Yeah, I think I could tolerate that. All right, good. I'll accept you at your word. Now think about this. The market hit bottom in March of 2009, as I recall. If you had started, and I'm going to use numbers that make the math easy, if you'd started with a portfolio of $1.2 million, that means that by March of 2009, you'd be down to 600,000. That's pretty ugly. But here's what people fail to understand is nobody knew that that was the bottom at the time. And in fact, everybody, and I mean everybody that I talked to who paid any attention to this stuff, was predicting it was going to go further down. In fact, it was going to be much worse. Yeah. The predictions most common were that it was going to drop another 2/3.
Wow. Yeah.
So that suddenly means that your 600,000 is going to be 200,000. Now think about that. That you're sitting in March of 2009, you have no idea, because nobody did, that this is the bottom, that things are going to get much better from that point on. You've lost half your money, and now the world is telling you, get ready, that's just the beginning, you're going to lose 2/3 more. Ask yourself, now are you going to stay the course? Because that's the real question. And I don't know, and I stayed the course, but I confess I was biting my nails, and because I cut and ran and panicked in '87, that's why I was able to stay the course, because I lived through doing the wrong thing. And I guess my point is, I'm not sure that I could have stayed the course just having read about what the right thing to do is, if I didn't have to live through doing the wrong thing, if that makes sense.
It makes perfect sense. We learn so much about ourselves. I always think adversity is possibly one of the best teachers, but it's really hard way to learn. I had the last quarter of 2018 was somewhat painful, and I had a client call and said, I was watching it go down, and I always thought, I'd be fine. 20-30% drops, no problem. And he said, but it got to 12%, and I was really starting to worry. And of course, then we had to have a conversation actually about tolerance for risk and all that sort of stuff. And we only really know when it's truly happening. Other than that, it's purely theoretical, and we have a tendency to deceive ourselves.
And you don't really realize, if you've never been through it, you don't really realize how painful it is.
I'm sure. I know it's going to come. I'm not looking forward to it. I was an advisor in 2008. My memory is that I spent about 6 hours a day on the phone, proactively calling out, asking people how they were feeling, reassuring them, not sugarcoating it, but just coaching them almost to stay in their seat, knowing that that was the right thing to do. But some pretty hairy conversations for sure.
And I have to say kudos to you for doing that, Pete. I remember reading there was a bit of research done in the U.S. I don't know if it applies to the U.K. or internationally, but the fact is that in the U.S., most money managers panicked more than their clients did. And I think there's a reason for that, by the way, because people like you and me, and who are paying close attention to this stuff, are, it's easier to get scared when you're watching it as closely as folks like us do. And whereas the average person who's not paying as much attention is that much less likely to panic. Which, by the way, I described to my daughter, who really doesn't care about this stuff very much. That's a superpower. Yeah, because investing is one of those things that the less you think about it and the less you tinker with it, assuming you get a couple of simple basic things right, which is low-cost index funds and hold it regardless of what happens in the market and keep investing, you just get those couple of things right, then your lack of attention is going to work in your favor. That's your superpower. Sure. And let me just also continue, because I was painting a lot of gloom and doom. When the market drops, it should be pretty much a non-event for anybody who follows my advice. So if it drops when you're in the accumulation phase, and you're 100% in stocks, which is my recommendation, assuming you're following that, it's good for you because you are constantly putting new money in. You have a high savings rate. Your earned income is half of it, if you're following my advice, but some large percentage of it is flowing into the market. So when the market plunges, you're getting more shares for those dollars, or in the case of the UK, those pounds. This is something you should celebrate.
Yeah, absolutely
now,
right.
If you're living on your portfolio, you need something else to smooth the ride that cash flow from earned income provides. And that, in my world, is when you add bonds. And so if the market drops and you have a percentage in bonds, that's your dry powder that you can shift over into stocks when you reallocate. And that allows you to pick up those shares at a bargain price. So not only should you not panic when the market goes down, you should look at the fact that there's an upside to it, assuming that you're following the couple of simple basic principles you should be following.
So in the decumulation phase, then, you would consider bonds not only to be a defensive position to somewhat mitigate the volatility of the portfolio as a whole, but also as an opportunistic play that you would consider then, drawing from bonds and reinvesting in equities when markets are down.
Exactly. And also, by extension, if you're living on your portfolio, maybe you don't shift those bonds into equities, but maybe you draw on those bonds for your living expenses, so you're not having to sell your equities when they're at a depressed price. And that buys you the time and buys your portfolio the time to recover as the market always does.
I think that's a crucial point, and there's an increasing weight of pretty academic research into just that. Jim, let's just sort of pivot a little bit. I wonder who your biggest inspiration has been on your personal finance journey. I'm wondering if it's actually been your daughter in a perhaps a backwards sense of being the inspiration. When sort of drafting that question, I was thinking, who had inspired you the most to do what you do?
Well, it depends on what you mean when you say do what I do. So if you're talking about my investing, then clearly that would be Jack Bogle, who was the guy who came up with the idea of index funds, who started the first one, and he's the founder of Vanguard. If you're talking about my blog and my book and my writing about investing, then absolutely it's my daughter. In fact, she teases me. She's an adult now, and for anybody who cares who's listening, she's firmly on the financial independence path and investing along the guidelines of the simple path to wealth. But as I said earlier, I kind of turned her off to it when she was young, and she stopped listening to me. And that, of course, as I mentioned earlier, is why I wound up launching the blog. And there have been enormous blessings that have come out of my starting the blog. I have the blog, I have the book, I do these chautauquas. I've met a lot of wonderful people over the last few years. I have the opportunity to talk to folks like you. And my daughter has gotten in the habit of reminding me that, Dad, if I'd listened to you, you wouldn't have any of this. It's only because I didn't listen that you have any of this.
So she takes the credit.
and as well she should, because, if she just paid attention when I was trying to convey this verbally, I wouldn't have bothered writing all this stuff down.
Well, yeah, that's our gain for sure. You mentioned the FIRE movement a couple of times recently. Here in the UK, it is really starting to gather pace. I think it's, like in most things, a few years behind the US. Why do you think the time is now for the FIRE movement? Why is it gathering such pace now?
I don't know that I agree with you that it is gathering pace. I don't know that I have an answer as to why. I mean, I think it might be as simple as the fact that the internet exists, that people like me started writing blogs, and now there are a lot of people writing about it. When I was trying to figure all this stuff out, I had no idea. I was wandering in the wilderness. I had no awareness of anybody else who thought the way I thought about this stuff or was trying to walk this path I was walking. I didn't even know there was a path. And now, of course, with the internet, it's much easier for people to connect and share information. And I frequently look at well, even my own writing, but the other writings, and say, wow, if I'd had access to this back in 1975, which was the year I started investing, how much easier, how much further along I would be. Sure. So it may simply be that, and I think that's one of the overriding themes, by the way, of the modern world, is that with the internet, the interconnectivity of human thinking and ideas has just exploded. And before the internet, you could share ideas with people who were in kind of your circle of influence and maybe even extending out as far as your own country. But now, my ideas are read by people in the furthest corners of the world. That's amazing to me. And by extension, I can read the ideas of people from those furthest corners of the world. And so I think that's one of the things that is allowing these concepts to expand. That said, I think it's always going to be a relatively small movement.
That's interesting, actually, because a couple of people have asked. I'm going to open it up to some questions that I received from my community in a second, but a couple of people have asked similar questions along the lines of, well, if everybody adopts this kind of approach, the purely passive indexed investing, the super frugal FI type thing, then won't that sort of mess it up for us all? So I wonder if you had a view on that.
Well, it would certainly make for a very, very different world. To be honest, I don't spend a whole lot of time thinking about what that world would look like or worrying about it, because I think there's zero chance of it happening. I think those of us in the FI community, we tend to be very aware of the FI community and very aware of the ideas in the FI community, and it seems bigger to us and more significant to us than it is to the broader world. And we lose sight of the fact, maybe, that while it is growing, it is a drop in the ocean of consumerist messages that are put out in much, much, much greater volume by companies all over the world who aren't doing something insidious, or it's not some great conspiracy, but they are trying very hard to sell their products as broadly as possible to as many people as possible. And they're always putting messages out to buy this or to buy that. And collectively, that's just a huge tsunami of messaging to buy. And against what we write about in the FI community, we're tiny in comparison. So I don't think the world is going to change in a significant enough fashion that would change how the fundamental investment opportunities we have, or the fundamental structure of the world.
Yeah, I think as long as humans are humans, I don't think there's any chance of that happening. I think the whole sort of FIRE thing, it feels like it's gathering pace here in the UK, but that might just be subjective. You're right, we tend to sort of bury ourselves in it. But it might just be that, something sort of piques your interest, you become aware of it, then you start to read it everywhere. But you're right, relatively speaking, it's a small message, but growing, yes, it's still a long way to go.
Yeah, the two things they can both be true. I mean, there's no question in the U.S. and I was just in the U.K. earlier this year, and then over in Europe, and there's no question that the whole FI concept is growing there, but you have to put it in context.
Yeah, sure.
It's growing in leaps and bounds, and the percentage gains are probably huge, but in the bigger world of the population of the UK, as an example, it's probably very small, and probably will always be a fairly small part of the population.
Yeah, I'd agree. Nick asked about home ownership. I imagine this will be a fairly localized thing, but we tend to be overly obsessed with buying property here in the UK, I think certainly relative to many other parts of the world. I wonder whether you had a view on rent versus own as your home.
Well, first of all, I mean, I think by and large, the U.S. is also obsessed with home ownership. In fact, it's one of the core parts of what's come to be called the American dream. The most popular, and popular defined by the most widely read on post on my blog, is a post that I titled "Why Your House is a Terrible Investment." And this is a post that's garnered me both the most love and the most hate.
I'm sure.
Because this is a very polarizing question. And because of it, I guess I have a reputation of being anti-house. So anyway, this post, Why Your House is a Terrible Investment, has garnered me both the most hate and the most love, because this is such a polarizing question. And it's given me a reputation of being anti-house, and I'm not. In fact, for the most part, for most of my adult life, and I'm an old guy now, I've owned houses, I've lived in houses. What I am against is the propaganda that buying a house is always, or even commonly, a good investment. It's not. It's a lifestyle decision. And when I bought houses, I never bought them with the idea that it was going to be some good investment. I bought them because they provided a particular kind of lifestyle that I wanted at that point in my life. For instance, when my daughter was young and in school, I bought a house in a particularly good school district. Now, sometimes houses work out wonderfully well as investments. If you happened, and I'm going to be focused on the U.S. because that's what I know. If you happen to buy a house in San Francisco or Boston or Los Angeles, you probably did really well over the last 20 years. If you bought a house in Detroit, you probably got killed. So this idea that buying a house is always a good idea is just not true. You need to go into it with your eyes wide open. And in my view, you need to buy just what satisfies whatever need you have and what you can comfortably afford. And I'm particularly against the idea of buying the most house you possibly can, because that's certainly not a good investment strategy.
Yeah, I'd agree. Home is home first.
Thanks.
Claire asks, she couches her question in terms of top 3 tips. I'll let you decide whether you come up with 3 or it's just sort of a general sense. But she says, 10 years ago, what would have been your top 3 tips? What would they be now? Have they changed and why? And do you see them changing in the future and why? So I guess she's asking, what the key points are, and do they change throughout life?
So I guess we could spend an hour on that. I assume Claire's asking about investment.
Yeah, primarily, I think, yeah.
Yeah. So I would say from an investment point of view, my philosophy is pretty much the same. So as I said earlier, I'm a big believer in index funds. So tip number 1 would be to focus your investing in low-cost index funds that track a broad stock market index. And then if you are at the point where you want to add bonds to your portfolio for reasons we discussed earlier, then that tracks a broad-based bond index. And that can be, if you're in the U.S., would be VTSAX for the stocks and VBTLX for the bonds. As I said earlier, if I was anywhere other than the U.S., I'd be buying global funds, a global stock fund and a global bond fund. That's what I would have said 10 years ago. That's what I would say now. That's probably what I'll say 20 years from now if I'm still around, with the caveat we talked about earlier that I think the trend is I'd be leaning more and more to the global thing, even as being in the U.S. Now, there have been some small adjustments that I've made along the way. For instance, at one point, I had REITs in my portfolio. That's real estate investment trusts.
Mm-hmm.
I had them in my portfolio as an inflation hedge. I've taken them out because it turns out REITs are no better inflation hedge than the total stock market index. And so I was already had the advantage of having that inflation hedge without the REITs. And of course, REITs are part of the total stock market. So basically, in owning REITs separately, I was overweighting those in the portfolio. The reason I had them, inflation protection, was unnecessary. And so by overweighting them, that really says, well, you think this particular sector is going to do better. And I don't think REITs are going to do better. I don't know, because I don't know that about any sector. So that's an example where I changed.
Very cool. You, just to bring you back to the bonds thing, because a gentleman who I've also interviewed on the show, a guy called Lars Kroyer, his sort of view is absolutely global stock portfolio in a low-cost index tracker. But if you're going to bring in bonds, stick to local denominated bonds and arguably government bonds. So here in the UK, that'd be gilts, treasuries in the US. So why global bonds then? Certainly given what seems to me an increasing correlation, certainly on global bonds latterly.
You know, there might be something unique in the UK and the laws and how bonds and bond interests are treated. For instance, in the U.S., you can buy municipal bonds that are free of federal income taxes. They pay a lower interest rate typically, and you have to figure out, well, is the tax savings worth the lower rate you take? So I imagine there are a lot of nuances with bonds. So there might be something I'm missing, and I'm willing to acknowledge that. But I'm basically taking my concept of the total bond market index fund in the U.S., VBTLX, and I think I would first look at if I were to go international with my investing. If I were to go globally, I'd first look at replicating that. Now, could be there's something I'm missing as to why that's not a good idea, but off the top of my head, I can't think of what that would be, other than there might be some, as I said, some nuances based on your particular tax bracket or the tax policies of the country you're in. Yeah,
maybe. Understood. Jim, one more question, if I may. Is there going to be a follow-up to The Simple Path to Wealth?
Another book?
Yeah. Given what you said earlier on about the pain of writing it.
I know, that's the thing. So I have an idea for one. I've kind of toyed with it, but I, as I mentioned earlier, I'm kind of an old guy, and it's, I'm at a point in my life where I put everything through the filter of, is this really how I want to spend my time? And I would go back to the Gloria Steinem quote. I love having written. I would love to have a second book out. Am I willing to put in the time, the effort, and the pain to make that happen? Yeah, stay tuned.
Well, look, man, I think if you were only to write one book, the book that you've written is a blessing to the world, and I'm so glad that you've written it. And I hope that as a result of me talking with you today, that more people will read it. I'm going to be doing a giveaway of 10 copies of this book, which will be wrapped around this interview. But it's a fantastic piece of work, Jim. So I just want to say thank you.
You're very kind, Pete. Thank you so much.
Well, I want to say thank you for being here. Thank you for giving me your time, and wishing you all the success and continued health and long life, sir. Thank you for being here.
The same to you, and thank you so much for the opportunity to talk to you, and by extension, your listeners.
Okay, how cool was that? For me, Jim has simplified the salient points, the important parts of wealth building, and particularly investing, better than anybody else. And that's really the power of the book. Yes, it's got a US slant, but not so much that one can't easily translate the main points to a UK perspective. So again, my grateful thanks to Jim for the generosity of his time. He's just a lovely, kind fella, and I just adored spending time with him. Hopefully I didn't fanboy too much. So, if you want to win a copy of the book, even if you've already got it, you could win one. Give it to someone whose future you care about, because it's that good. To win a copy, head over to the show notes, meaningfulmoney.tv/simplepath, and you can find out what you need to do there. There's a few ways you can enter. The idea is really about building awareness of Meaningful Money, so you can help me by joining in and sharing it on different social media platforms. You can join the email list, all that sort of stuff. So head over there and check out what you need to do. meaningfulmoney.tv/simplepath. Okay, review from Grouty11, who headlines the podcast Simply Great UK Finance Podcast. They say there's a lot of people offering advice in the UK, provided you'll pay for it, and a lot of people offering free information if you're in the USA. This podcast combines the two being a great source of free information on personal finance for UK-based people. Give it a listen. Thank you very much, Grouty11. Really appreciate it. If you like what you're hearing here, meaningfulmoney.tv/iTunes if Apple is your thing. Otherwise, wherever you're listening to this show, if you can leave me a review, please do so. It helps keep me near the top of the rankings, which is really, really important. Okay, quick reminder that the first phase of Meaningful Academy is now open to everyone. We did a founders launch in the middle of 2019, but now it's open to everyone. So if you're looking to get started with your finances, the first phase, which we call Financial Foundations, is perfect for you. Covers everything from mindset and goal setting to setting and sticking to a budget, debt elimination, basics of personal insurance, and the basics of saving and investing. Loads of video lessons, worksheets, calculators, basically everything you need to start your personal financial journey on the right foot. It's kind of my best thinking distilled into one place, and I know it's going to be helpful for you, getting great feedback already. meaningfulacademy.com is where you need to go. All the info you need is there. But don't forget, as a podcast listener, you get 25% off by using the coupon code podcast25. Okay, there's instructions on the sign-up form as to how to put that coupon code in. Podcast25. Don't forget that. Okay, next time I'm going to be talking about the Bank of Mum and Dad with CEO of Family Building Society, Mark Bogard. Really interesting conversation about the increasing pressure on parents to help their kids, the different ways that they can do so, and both the benefits and potentially some of the downsides of doing so. So stay tuned for that next week. It's a great conversation. And that's it for this session of the podcast. Hope you enjoyed it. Hope it was helpful. You know what to do. meaningfulmoney.tv/simple path for any questions or comments, full transcript, and of course how to enter to win a copy of Jim's book, The Simple Path to Wealth. Thank you so much for listening. I'll talk to you next time.